Good morning, ladies and gentlemen, colleagues, as well as people interested in climate, but also what the financial landscape in South Africa looks like as we endeavor to implement our decarbonization journey. But as you all know, in the course of doing that, to do that with justice at the heart of it. Today is a very special day for us in the PCC because it marks the launch of the Climate Finance Landscape Report 2023, which covers essentially the financial years of 2019 to 2021. And it gives me great pleasure in welcoming Lungisa Fuzile, who is a commissioner, but who is also chair of the Banking Association South Africa. In addition to that, not for marketing purposes, but he also serves as the CEO of one of South Africa's largest banking groups. Having said that, Lungisa previously was also the Director General of the National Treasury, and therefore, from both a public and private finance point of view, we believe that there is no better person qualified to talk to the significance of this climate finance landscape report than he is. With those very short introductory words, I'd like to welcome Lungisa Fuzile to make the keynote opening address for this launch of the climate finance landscape report. Welcome, and thank you for agreeing to be with us today, Lungisa. You're muted, Lungisa, I'm afraid. I'm afraid we still can't hear you. While we're waiting for Lungisa, I see Karen Ayrton already at this stage has her hand up.
Is there an admin control that you could give him speaking rights?
I will ask the technical people, but I think he called in from his mobile device.
No, it would be, you might have control and you might have to allow him speaking.
Thank you for that, Karen. Thanks very much for that advice. I see Catherine Gwynn Evans also has her hand up. Our apologies, ladies and gentlemen. We'll resolve this as soon as we possibly can. Ladies and gentlemen, while we try to resolve this and just being somewhat fleet-footed, may I suggest that we proceed with the presentation of the landscape report findings and then give Lungisa a chance to come in and make his remarks at the end of that. So with that, I'd like to hand over, please, at this stage to Christelle Bayers, who will make some opening remarks as well as introduce the team that did the mapping and tracking and finalization of this report. Thank you very much. Christelle.
Thank you, Deepak. Good morning, everyone. My name is Christelle Bayers. I am the manager for the climate finance sector and capital markets in the climate finance and innovation team with Deepak Patel and Kwezikazi Vindful. It is truly a highlight for our finance team as well as the project team to launch this report today. We are on the eve of the 28th Conference of the Parties of the UNFCCC, and this year calls for concrete climate change action and progress towards achieving South Africa's vision for a low carbon and climate resilient economy. In this context, mapping and understanding South Africa's climate finance flows and the opportunity to share this knowledge on a global stage is a critical value addition for South Africa. I'm therefore very pleased to facilitate this session in which we will present the key findings of the South Africa Climate Finance Landscape Report together with the project team. This report has been commissioned by the Presidential Climate Commission with the Climate Policy Initiative and Green Cape, thus effectively merging rigorous global best practice in climate finance mapping and frameworks with deep contextual climate finance expertise to reach the findings that we will be presenting here today. The South African Climate Finance Landscape Report provides clear, consistent, and standardized methodological information on current climate finance investments, and this provides us insight into the gaps and opportunities, and it provides an opportunity to engage with the audience today as well as at a global stage at COP28, and to mobilize and scale up climate finance in South Africa. This report provides a critical empirical baseline that allows integration of this work with other climate finance initiatives, specifically in view of modeling climate finance impacts vis-à-vis investments required. And it allows us to start to reconfigure and rethink in terms of innovative transition mechanisms for South Africa. So what this report does and this research does is it identifies the building blocks. It gives us the modalities, the direction of climate finance investment, as well as the quantum of current finance flows. And it allows us to thus reconfigure, and think innovatively about the climate finance landscape that is required for a just transition in South Africa. I am very pleased to announce our speakers who will be presenting the details of the report. Darshan Wignaraja leads the Climate Policy Initiative's UK-based team, and Jack Radmore is with Green Cape and he's leading their energy program. Jack, I'm handing over to you. Thank you very much.
Brilliant, Christelle. Thank you so much. And Deepak, from your side as well, thank you so much for giving us this opportunity. Good morning, ladies and gentlemen. We're really excited to be participating in today's launch. And I thought it would be sort of incorrect of me not to kick us off just with a quick thanks, I think particularly to the Presidential Climate Commission for taking this leadership role in trying to unlock decision support mechanisms like this climate finance landscape. So I really want to thank the PCC for taking on this role and for pushing forward work like this. Also, just a quick word of thanks to the funders that made this work possible through the ACF as well as AFD, and then particularly to Darshan and the team from the Climate Policy Initiative, the team that really are the international experts in doing this type of work. And then to our steering committee as well from the project's perspective, many of which are here today. It wouldn't have been possible without that team. So I think with that, we're going to jump right into the presentation this morning. I'm going to share my screen. Christelle, hopefully you can just let me know once you can see it.
Yes, I can see it. Thank you.
Perfect. And then, yeah, as Christelle has already indicated, this is a technical report prepared for the Presidential Climate Commission to really provide an insight into the climate finance landscape 2023 and provide an update of what was done in the previous iteration of this report. We thought it worthwhile to start with the methodological review of what went into setting up this report, and there is no one better suited to provide that insight. So Darshan, I'm going to pass over to you to kick us off with that methodological breakdown.
Thanks, Jack. I hope you can all hear me well. What a pleasure it is to be here this morning. I'm very excited to be here for the launch. I can't tell you how passionate Climate Policy Initiative feel about doing work in specific geographical countries, and South Africa really leading the way with this type of assessment. So I salute those who are supporting the work, and especially the PCC. I'm going to take you through the methodological approach we followed for this report. I'll try and keep it short, but please feel free to put any questions in the chat and we'll loop round to them after we've been through the findings. This report has a bit of history. CPI, Climate Policy Initiative, and Green Cape did an independent study back in 2021, which aimed to provide a snapshot of climate finance flows in South Africa. This covered flows in 2017 and 2018. The current report builds on that study and follows the South African Green Finance Taxonomy's climate finance definitions and sectoral classification. So what you see on the screen under the both the definition at the top of the screen and then what we track. Climate Policy Initiative has a decade-old established, robust and well-accepted climate finance accounting methodology, which we've leveraged across and through this report. What we are tracking specifically is the primary capital flows and investments, and we cover, as Deepak mentioned at the start, 2019, 2020, and 21, and we present that data as an average over those 3 years. The flow numbers are adjusted for inflation to show the real growth and make it easy to understand the figures and the flows that you're taking a look at. We do not track, and I want to be very explicit here, secondary market transactions. At this stage, we don't track transition finance, given some of the complexities around definitions in that space. We don't track disbursements, guarantees, and insurance. Potentially, in future iterations, these could be exciting areas to expand into as granularity of data becomes more available. We acknowledge the importance of risk management instruments like guarantees and insurance in enabling private climate flows, in particular to areas and sectors with low risk appetites for private investment. During the next year of this partnership, we will be focusing on some of these areas in capacity building. It's important to highlight that this approach, or the approach we've taken, has some key foundational principles. Number one, we take a conservative approach. In cases where there is no clarity on the climate component of an investment, we stay on the cautious side and we exclude that information. Second, we seek to avoid double counting as we track data from different sources. The project team mitigated this risk by adhering to consistent approaches to tracking and triangulating data using the available unique project ID codes wherever possible. And finally, we prefer project level versus aggregated data wherever possible. The final data set contained a combination of aggregated and project level data, and we prefer, as I said, project level data. I think of the total tracked climate finance for this report, approximately 92% was tracked using project level data, which is a high ratio and something we're pretty comfortable with. On the next slide, onto typology, we have different types of public actors, such as governments and DFIs, as well as private actors, such as corporates and financial institutions. We also have 5 types of instrument: debt, which we divide between commercial debt and concessional debt, equity, grant, and budget expenditure from the national government. Activities are classified between mitigation and adaptation, or dual benefits, where both are covered, both mitigation and adaptation. And finally, we cover 9 sectors following the South African green finance taxonomy that you can see listed here on the right-hand side of the slide. Jack, next slide, please. I just want to highlight the limitations. The data was collected through both qualitative and quantitative methods carried out by both CPI and Greencape to provide the most comprehensive assessment we could. On this image, you can see areas where we had real confidence over what we tracked, some areas where there was more limited capability, and some areas where it wasn't tracked because the data at this stage was difficult to source. And these were supplemented by more than 70 interviews, and I think the data sets and direct surveys covered over 50 development finance institutions. Over time, we're definitely seeing an improvement in the coverage of data sources, which also renders the previous landscape numbers that I talked about earlier as not directly comparable. But that being said, methodological issues and data limitations do still persist, as highlighted here in this slide. The gaps are especially prominent in areas such as private investment flowing into agriculture, transport, water, and adaptation investment by public actors. Those key areas remain tricky, and I would say are consistent with what we see in other countries as being very challenging areas to track. We believe that we shouldn't let perfection become the enemy of the good. There's sufficient data and improvements through this iterative process. Over the next year of capability building, we'll be able to go further to plug these gaps. And as many of those of you who fed into this work improve the granularity with which you're tagging and refining data, we will only get a richer picture moving forward. Jack, over to you for the findings.
Brilliant. Thank you so much, Darshan, for setting up and articulating CPI's internationally renowned expertise within this climate finance mapping space. So we are going to provide some of the sort of highlights of this report. The report will be available for download post this event. There's a lot of data and a lot of insight, so I'm trying to really capture a very high level insight to that, but please do go and download the report, have a look. And ultimately, the push is to get in touch post that report to get a better understanding of what are the opportunities for you as investors, as companies to adapt to this report, but also where are the major gaps that we're looking to fill as a country to overall meet what we're trying to achieve. So I'm going to try and fly through some of these overall findings. And I guess the starting point really is this Sankey diagram. And ultimately, this is the outcome of the South African climate finance landscape for 2023 that provides a very clear indication of the flows of climate finance from the original source all the way through the disbursement mechanism and to the final projects and sectors in which they land. Providing a very nice insight as to where we see these flows happening, and again, potentially where there are ultimate gaps. So for this report, we were able to track 131 billion rands worth of annual investments. Again, that's averaged over the 2019, 2020, and 2021 years, and provide a very nice insight as to where that money is coming from, how it is being dispersed in the South African market, and ultimately into which sectors it is flowing. I wanted to break this down a little bit more. And I think the first bit is to understand that the majority of this finance is coming from domestic sources. So upwards of 91% to 119 billion rands per annum is coming from our domestic public and private sources from the point of view. And this for us is a really exciting opportunity to highlight, because there's often a misconception that we're dependent on international finance to drive our transition. But a lot of the good work is already happening in-house. And I think with the additional pushes around policy certainty, around increasing the investment landscape, we can increase this amount and ultimately drive that number forward. Our international sources accounting for about 9% of the 131 billion rands per annum investment. Majority of that is coming from sort of our Western European countries, including Germany, France, the UK, etc. A lot of overlap between our Just Transition PGI partners as well in that overlay. Breaking that down just to get a better view of the private versus public flows within that 131 billion. Private actors were the predominant source of climate finance, accounting for 86% or 113 billion rands worth of investments. And that is dominated by our commercial banks that were accounted for about 61% of that total flow. So really nice to see our commercial banks taking an interest and a push towards investments within these clean or low carbon sectors. And I think that speaks very heavily to the type of market that South Africa has created around investment ready and a strong investment case within low carbon sectors. The public sector here, obviously covering both our development finance institutions, our multilateral climate funds, but also our government expenditure, accounting for about 14% of the tracked climate finance, with our a large DFIs combined with our multilateral climate funds being the dominant source there, accounting for just over 55% of that total investment. It's really nice to land this sort of number or this split in comparison to the rest of Africa, but also the global numbers. So as we've said, the CPI is the internationally recognized entity for mapping this type of work, and they have done both an African study, and there's links available, and a global study to understand that split. And for us, it's very interesting to see that South Africa sits quite differently, both from the rest of Africa and the global numbers, with that heavy private sector focus from an investment point of view. And again, this does speak to the type of market that we've created, the investment appetite for investments into the climate spaces, but then also the returns that can be generated through investments within our private sector climate adaptation. The rest of Africa, very heavily focused on public and DFI spend, upwards of 86%, so pretty much a flip from the South African market. And then the global sits much closer to a 50-50 split between public and private spend. So throughout the report, we've tried to land the South African numbers in comparison to the rest of Africa and to the global numbers, and provide some insight as to why we see that difference. Clean energy within the private sector market continued to be the dominant sector that received funding from the private sector. If we include both clean energy generation as well as energy efficiency and demand response, it covering more than 85% of the overall investments within the climate finance landscape. Purely investments into clean energy accounting for 65% or 72 billion rands per annum. And that obviously is as expected with the continued load shedding that we've been experiencing, and latest numbers indicating 2023 already doubling the 2022 number in terms of available load shedding, and Eskom's projections for next year and the year that follows, painting a pretty bleak picture in terms of continued load shedding. What for us was very exciting in this private sector flows was an increase in the amount of flows into the agriculture and water conservation, supply and demand sectors. A number of different reasons for this. I think from a water perspective, it was as a response to the national drought during these years and some investments into private water demand. On the agriculture side, the agricultural sector has seen an economic growth over each of these 3 years, quite a significant growth, even through challenges in 2017, 2018 with avian influenza, and really nice to see the private sector starting to find investment opportunities within that space. From a public sector spend perspective, a bit more of a widespread across our cross-sectorial investment spaces. As can be expected, clean energy continues to be the dominant sector, and I think will continue to be the dominant sector over the next couple of years, particularly with our current space, but obviously a little bit more investment into our general ecosystem response and our cross-sectoral investors like disaster response, our sort of general ecosystem management, etc. For us, it's very important that we start to look at where our different entities are spending their money and where should they be spending their money to catalyze larger scale investments. I'll come back to that thought, particularly around DFIs, towards the end of the presentation. So that's the sort of source perspective of where the money is coming from. The majority, more than 75% of the 131 billion rands worth of annual investment was distributed using debt instruments into the South African market. The average cost of that debt was between 10 and 12%. And again, landing this in comparison to Africa and the global landscape, we can see that we again have quite a different picture. Africa quite dependent on government budget expenditure as well as concessional debt, where the global picture has a much higher equity portion playing a much stronger role in their transition. A couple of things to note beyond the focus on debt is the very low concessional debt number in the South African landscape, as well as the very low number from a grant perspective in the South African landscape. Less than 3% of the total 131 billion was captured using concessional debt and grant finance. And that, for me, is a massive call to action to rethink how and what we're positioning towards grant funding in the South African landscape. With energy being the dominant investment sector, mitigation obviously has pushed forward as the ultimate sort of sector that received the most amount of finance, accounting for 81% of the overall flow. But for us, what's really concerning is the amount of finance going through to adaptation sectors. Less than 12% of the tracked climate finance being targeted towards adaptation. That is quite a lot below the African continental average of 39% going into adaptation focus. Although that is quite low, it is to be expected. South Africa has a relatively high emissions portfolio in comparison to the rest of the continent. And with our sort of heavy coal-based electricity generation, for example, one would expect a much bigger focus on the mitigation sector and perhaps a lesser focus in the early stages towards adaptation. But that's not to say that as we grow and continue, we would like to see an increase in that adaptation finance, particularly from the private sector and our DFIs. What we do want to do, as Dashan mentioned, in the future work is start to integrate just transition finance into this classification to understand how are we mapping towards some of our just transition commitments, and how do we start to see the interplay between investments in adaptation, mitigation, and dual benefits, as well as the just aspect of the South African transition. As Dashan mentioned, we released in 2021 a report that looked at the 17 and 18 years, and this is now obviously the update of that. So we wanted to note some similarities and differences between those two reports. So overall, to start to track where we are moving as a country in terms of our climate finance investments. As a start, the climate finance commitments have more than doubled, with annual average of 62 billion in that first report per annum, and the average of 31 billion per annum in this. Overall, we are still significantly behind on the spend that is required to meet our climate objectives. And again, I'll come back to positioning that within some numbers, but we are up to 5-fold behind on what we are needed to actually meet some of our existing commitments. What we have seen is a very nice continual growth in our annual average investments over the years. We had one question previously around, have we been able to see an impact of the COVID-19 pandemic on the availability of climate finance? This data set showed no negative effect on the overall amount of climate finance available. But as we head into the next report, which will sort of be targeted towards 2024, 2025, we may perhaps see a little bit more of the effect starting to come through there as we track some of the key years ultimately affected by the COVID-19 pandemic. Some of the common trends that remained: private actors, particularly commercial banks and institutional investors, continued to be the largest investor in the climate finance space within South Africa. There was a minor downward movement of public finance. Our expectation that this is due to increased accuracy within public sector tagging and a real push for consistency around what is being classified as climate finance on the back of the amazing launch from National Treasury of the Green Finance Taxonomy, etc. Clean energy, both generation and efficiency, continues to be the dominant sector between the two reports, debt being the primary instrument that is being used, and I expect that to continue. And then a marked reduction or a marked sort of lower amount in terms of adaptation finance compared to mitigation finance. Some of the big differences for us was firstly the grant financing that I already mentioned. In the 21 reports, it accounted for 5% of the annual investment. That has now dropped down to less than 1% of the tracked investments. This may be one of the impacts of the COVID-19 pandemic, where we haven't seen an overall reduction in the amount of climate finance, but it may have influenced the amount of grant funding that was available for the climate sectors. But I think this is very much a call to action to look at, one, where are we targeting our grants? Are our grants well designed? And I think particularly the challenge of availability versus accessibility. So the grants may be there, but are they being dispersed and are they actually accessible by the projects that need them? And the landscape showed an overall decrease in both in the sort of concessional debt available, but also a reduction in the concessionality of that debt. So only 2% of the tracked investments was concessional debt, and overall the concessionality of that debt was decreased, with a much higher focus on that cost of debt towards 10 to 12%. What's very nice for us, as I already mentioned, the agricultural sector, seeing a continual expansion, particularly from our private investors, moving from 1.6 billion rand per annum to about 16.7 billion rand per annum. A marked increase in investments from the private sector in water, again on the back of the droughts, and particularly with focus on the wastewater systems. If you've not read the latest release of the green and blue drop reports, I recommend having a look at those. But a movement from 1.9 billion rand per annum to 4.8 billion rand per annum. A worrying reduction in investments into low carbon transports from 2.2 billion rand per annum down to 87 million rand. This, again, it shows particularly worrying investment trend, given the importance or the relevance of carbon emissions from our transport sector, but also the importance of local manufacturing of internal combustion engines to our overall GDP, and the inclusion of bans of imports of those vehicles into some of our key export agencies. So how do we start to transition that sector to make sure, one, we are reducing the carbon emissions from that sector, but also starting to look at manufacturing lower emission vehicles to actually export to some of those key markets as well. What we've tried to do is land this number of 131 billion in an estimate of what it's going to take for South Africa to meet both our net zero commitments and our nationally determined contribution commitments. There are a number of different studies that position the overall amount that is needed. It was not within the scope of this study to try and estimate those, but what we have done is looked at a cross-sectoral average of all of those different studies and came up with these two sort of average numbers of 334 billion rands worth of annual investments needed by 2050 in order for us to meet our net zero commitments, obviously over a longer time frame. And then looking at our 2030 NDC commitments, needing about 535 billion rands per annum in order to meet that. And you can see quite quickly that there's quite a significant shortfall, just over 200 billion needed to meet our net zero, and just over 400 billion rands per annum if we are to meet our NDC. So again, a call to action that an additional amount is needed, more support is needed, more investments are needed if we are going to actually meet what we've committed to over the next couple of years. In the next report, I'd love to see that addition of the just transition aspects of what we need to meet our commitments on that aspect. There are some sort of continual overall investment barriers that the investment community have highlighted across the sectorial changes. And what's very nice to see is that there's a very close correlation between the existence of economic policy and skills barriers within a specific sector and the overall availability of climate finance, and then the sort of investment sentiment by the sector into those areas. So if we take clean energy, for example, a relatively strong business case, so low economic barriers, there are still some work needed on our policy space as well as our skills space, but overall a relatively low entry barrier within that space, and overall strong availability of climate finance, and a low perceived investment risk from the majority of our investors. If we compare that, for example, to something like low carbon transports, where the business case is still a little bit hard to make, there are a number of policy barriers, and the skills availability remains quite challenging, we see that low availability of climate finance and a perceived risk from an investment point of view. So I think this is, again, a call to action from our development partners in the room to really start to look at how do we address some of these key economic policy and skills barriers within the sectors where we want to start to stimulate additional private and public investment. What do we need to do to bring down that perceived investment risk? What do we need to do to increase the overall availability of climate finance on the back of reducing some of these key barriers across the sectors? A number of sort of climate finance barriers remain consistent within the financing landscape, and I wanted to highlight a couple of them, and hopefully no one's going to shoot me for these. But the first is we continue to see a very limited appetite for early stage and venture capital space in South Africa. We have a number of VCs in the country, but they invest much later stage than traditional VCs. And this is true both from a company level investment, but also from a project preparation investment perspective. There remains a challenge around the creation of an investment ready pipeline of low carbon projects. So a lot of work needs to go into prepping and creating that pipeline that actually can be invested into. From an adaptation perspective, there are challenges around data limitations. The adaptation sectors are new. There is not a lot of information available to investors on successful projects, on projects that have worked, and projects that are able to show key adaptation impacts. This is the one that I think we often get a bit of flack for. But what we are seeing is that the impact investing space, particularly in the climate sectors in South Africa, remains extremely small. We maintain investments in sectors where we can see financial returns over those that are needed from an impact perspective. Our local funders that are getting international currency are struggling from a forex risk perspective. So those that are receiving investments in sort of perhaps dollars and trying to lend again in rands are unable to match or take on that forex risk perspective. And then there's a particular continual challenge across the public and private sector from an institutional capacity perspective in actually exploring and understanding the climate investment landscapes, but then also starting to push investments and track those investments within the overall landscape. A couple of the key takeaways for us. From a data tracking perspective, and we're obviously looking to continue this data tracking perspective, it's very important that we push both from a public and private perspective a continual alignment with the South African Green Finance Taxonomy that is available to have a look at. It is a standardized approach. It allows us to have a good indication of where we're going. It allows us to make more informed decisions. It's also very important that we continue to try and explore the interoperability of the South African green finance taxonomy with international taxonomies. This is perhaps the easiest approach to stimulate cross-border investments. If we can find that interoperability of the different taxonomies, then an investor who is making an investment from the UK can both count their investments on the UK taxonomy, but also into the South African taxonomy. There's a need for greater alignment and transparency around reporting, particularly on impact outcomes between our local and international development finance institutions. Here for us, it's very important that we're having open and continual communications between particularly the DFIs to make sure that the investments are going into the places where investments are needed, and perhaps DFIs should move out of areas where commercial and private sector investors are already active and try to take on some of the areas that are slightly more riskier, and perhaps look at how do we de-risk those sectors and then exit as the private sector enters. And then for us, the really important aspect of incorporating gender equity and social inclusion considerations into the climate budget tagging aspects of both private and public sector tracking. Areas like Mexico, for example, are leading the charge in terms of integrating that into their taxonomies and tracking methodologies. Key overall takeaways: South Africa requires 134 billion rands per annum and 535 billion rand per annum to meet our NDCs and net zero pledges respectively. We are significantly behind on that. Additional work is needed around awareness, capacity building, and alignment, particularly between the public and private sector. Additional work is needed to stimulate that early stage project preparation, early stage development from a company perspective. How do we increase that pipeline of bankable projects? We need to continue to push around this tracking, measuring, and monitoring and reporting of our climate finance flows in order to inform our decision making. And then again, ultimately that call for greater alignment and transparency between particularly our development finance institutions. And I think that my sort of closing thought here and closing takeaways, as Darshan mentioned, we try and track this from an individual project perspective and then move back up the chain. And what you see when you measure and take that approach is that the landscape of climate finance is very much an interlocked web of balance sheets. So someone's asset is someone else's liability, and so on and so forth as we move up that chain. And it's very important that we start to explore whether or not we're targeting those balance sheets at the right sectors. Are they doing the right type of work? And within this interlocked landscape, which of those balance sheets still have some elasticity within them that we need to push, and which of those balance sheets are at their stretched point and can't be pushed more for additional investors. And I think as we start to see this as a complex adaptive system, we're going to better be able to target specific balance sheets at key investment areas to unlock that 334 billion and 535 billion rand per annum that's needed to meet our overall commitments. That was a lot of numbers to fly through quite quickly. Hopefully it whets your appetite for what is available in this overall report. Please do go and download it. Please engage with the data. Please reach out to ourselves, the PCC and CPI, to continue this conversation, to unlock opportunities for more investment, but also to inform decision-making as to where perhaps we're falling short. So thank you very much for letting me present a lot of numbers at you. And I really hope that this is the beginning of a long-term conversation between this group and help us meet our NDCs and net zero commitments. Thank you very much.
Thank you very much, Jack and Darshan. We are already tracking quite a number of questions in the comment section. Thank you for that. There will definitely be time to address this. I am going to hand back to Deepak Patel as the facilitator of this event. Thank you, Deepak. Back to you.
Thank you so very much, Christelle. And a very special thanks to Darshan and to Jack for presenting the outputs and the perspectives that emerged during the course of this project. I need to reiterate that this is a multi-year project, and it's quite important as we look at the baseline years that were set and recognize that this was not only during the time of COVID, but it also predated South Africa's revised NDCs as submitted to the UNFCCC, and secondly, also predated the JET investment plan. And so being a multi-year project aligned with the green taxonomy, we see this as a very important endeavor on an ongoing basis. A special thanks as well to Christelle, who managed the process of landing the project in the right place, but just as importantly, to the CPI team and the Green Cape team, it's been an absolute pleasure to work with you in this respect. And finally, to the steering committee of the project, made up not only of PCC Secretariat and Commission members, but also from quite a wide array of experts as well as academic institutions who steered the course of this project. Final word, this project is not intended to provide answers or be the panacea for mobilizing and scaling up climate finance. It is intended and will remain so, a very empirical base of information from which the PCC in particular, but other players as well, can take a cue about what we need to do as players, institutions, and stakeholders in the ecosystem to adequately raise the finances that are needed for our transition. Without further ado, let me ask Lungisa Fuzile, who I introduced earlier, to make some remarks as well as responding statements, and to talk about how the PCC views this work going forward. Thank you very much. The floor is yours, Lungisa.
Thank you so much, Deepak. I won't even ask this time if you can hear me, lest you tell me no. I will just carry on and make my remarks regardless. Apologies for the stumble earlier this morning. You know, when I reflect on the short life of the PCC and my even shorter stint with it, because I joined midway, I mean, I cannot help but feel very proud to be South African. I don't think that many countries have got what South Africa has. The ability to pull together people from very diverse backgrounds, all walks of life, from different persuasions, have them under an umbrella body like the PCC is. Create a platform where people can air views, researched views, sometimes opinions on as important a subject as climate change and how we help our country transition in a just manner from the present to a future with low carbon emissions. The view of the PCC is that this report is going to add yet another critical instrument in the debate on how we finance the project of the just transition, how we finance both mitigation and adaptation. And of course, what I value a lot about how the PCC is run is the fact that you can make any point you want to make, but you must put on the table evidence, empirical evidence to back your point. People challenge you. So this report will, without a doubt, add a lot of value in the quality of the debate of the PCC in the period ahead. Couple of strands come out of the report, and I won't repeat what Dashan and Jack very eloquently and capably went through, but I will pick or shine the spotlight on a couple of salient points, more to make my own points about what those particular points from the report suggest about our landscape as South Africa. Firstly, there is no doubt that on balance, the bulk of the funding that we have seen so far has come from domestic sources as opposed to foreign sources. It's a very powerful point, this, because I suspect that in the public discourse, an impression, and I could perhaps add a wrong impression, has been created that our transition will be financed externally. At this point, the evidence in this report suggests that nothing could be further from the truth. Now, when I make this point, I'm not being narrowly nationalistic and diminishing the importance of foreign funding. We need it, and we need lots of it. But I'm making a different point, and I think a fundamentally important point, which is that as an emerging economy that happens to have a sophisticated financial market, a sophisticated private sector, I say this with humility, we do sometimes have to introspect and understand that strength that South Africa has, which other jurisdictions that are categorized also as emerging countries don't have. So I think we should be proud of this. We should celebrate it. We should leverage it as a strength as we launch into a future of our just transition going forward. I mean, it's important to see that 86% of the funding has come from the private sector. And that has been facilitated in large measure by the level of sophistication of our capital market. The other important strand, and on another occasion I made this point, is the fact that debt finance is also an important part of the financing of our climate change agenda. Now, debt finance sometimes gets frowned upon, and correctly so. Fiscal rectitude has got a place. Making sure that you don't indebt future generation is something that does require thought. However, if debt is used to finance great initiatives that have got a big positive intergenerational impact, then debt is good. So I do want to underline that point and emphasize that we must, where necessary and within reason, encourage the use of various debt instruments to finance various aspects of the transition. Of course, guard against raising debt and wasting that money, because then that positive intergenerational impact would get lost. Another very important strand that comes from this report is, and this has puzzled me, maybe it doesn't puzzle experts like yourselves, at 80% or so, the resources allocated to mitigation strike me as being disproportionately large. Now, if you were to ask me, why do I feel disproportionately large? I might not be able to come up with intelligent empirical evidence to suggest that that is the case. But I just raises some alarm bells for me that so much is going to that particular sphere. Now, that is where structures such as the PCC, among others, become important. Yes, we must see to it that resources are mobilized for financing climate change, but we must also look into the efficiency of the allocation of those funds within the spectrum of climate finance. We must, because naturally what tends to happen is that those who control, manage, or influence these pools of funds tend to look for the areas that they can understand well, that they can understand the risks associated with exposing their balance sheet to, and therefore can be able to price such risks. And you can understand their logic. What we do have to do then as the PCC is to say, what are the reasons why ordinarily people wouldn't channel resources to, for instance, adaptation and whatever other area is lacking? Jack was just saying now that areas like transport, if I understood him very well, seem not to be receiving sufficient attention or sufficient resourcing rather. So we've got to then say, one, identify the areas that ordinarily the private sector wouldn't channel funding towards, understand why that is so, and influence decisions on policy instruments and interventions that would then bring about the change that we desire. In other words, the channeling and allocation of more resources towards those areas to the extent that that is needed. I do want to join those who have posted on the chat glowing comments about the excellent quality of work that this report represents. Of course, I want to end on a note that says it shouldn't be like other good reports that we've seen previously, where people stop only at showering those who put them together with praises as to the quality of the report. If it's good, then we must use it. I mean, I for one, and I think that other commissioners would agree with me, we should popularize this report. We must make sure that people know about it, use it in future debates. And of course, we must be open to critiques of it so that the next edition can be an improvement on it and compensate for whatever flaws or close whatever gaps there are in the current report. I mean, I really raise my hat proverbially for those who commissioned this work and of course those who did the hard slog of putting it together and getting us here. Thank you very much, Deepak. Thanks to everyone, and sorry again for the earlier glitches.
Thank you very much for that, Lungisa. Very illuminating and deeply thoughtful words from you. Let me also echo once again the thanks to the entire team. There are a lot of people behind the scenes, not just the presenters of the results, that have enabled this work. Let me now turn to one of our first of three respondents to the report. And if I can please welcome Boitumelo Mosako from the DPSA. She is in fact the chairperson, the CEO of the DPSA. Before being appointed Chief Executive Officer recently, she had a number of years as the Chief Financial Officer of the DPSA. She is an experienced chartered accountant, as well as has a number of academic accolades to her credit. And without further ado, let me ask Boitumelo, please, to be one of the respondents to having heard the output of this report. Thank you very much, and the floor is yours, Boitumelo.
Good morning, Deepak, and to all the participants in this meeting. Firstly, I would like to echo the sentiments expressed by Lungisa in commending the PCC for this excellent work that has been done. And data is a critical part of decision making, especially on the investment side, and it's always good for us to have these reports and the baseline shifting, and us seeing the progress that we have made thus far as a country. South Africa is a great country, and we have all the resources and all the capacity we need to ensure that we achieve the objectives that we set. This report is well researched, well structured, and there are, just as much as we still finding it challenging to really estimate how much it's going to cost to close the SDG gaps, to really achieve the just transition energy for our country. We really welcome what the report provides. We commend the robust methodology that has been used in this report. We do recognize that the definitions remain a challenge, especially around climate finance and transition finance as well. We think, Deepak, this is sometimes we use those terms interchangeably. I think as an African state, it's going to be critical for us to really clarify these definitions going forward, because we need to ensure that we are clear and also appropriate these definitions for our context as Africans. Now, the report correctly notes that mitigation finance has represented over 80% of the climate finance flows, with adaptation projects counting to, continuing to lag behind. And I think, this is the same, issue that was raised by Butlingisa earlier on. This matter must be elevated in the report as a challenge to ensure that going forward, more effort is put on adaptation to really influence behaviors. The mitigation interventions tend not to have permanent effects as well. And I think finally, and something very important to us, is the broader matter of coordinating financial flows. And this is, another matter that has not been addressed in the report. And this, as we do more reports, it's going to be important for us to start seeing how the coordination and the impact thereof works. And the PCC is actually, well positioned, Deepak, to really start driving some of these recommendations. It is our view that one of the recommendations in this report must be to finalize the transition financing mechanism and its coordination as well. What I like, and that really stood out from this report as well, is how the climate finance ecosystem is coming together. And this, report shows those elements around the ecosystem. The earlier presenter, touched on other aspects that will impact the flow of financing, because sometimes we focus on mobilizing financing, and the issue is then to say, when the money is here, what do we then do with it? So the elevation of issues around skills development, the creation of supply chains, value chains, the building design and building frameworks that we need to consider, the project preparation elements as well. All of these, contribute to the ecosystem and building blocks to enhancing financial flows as well. Key insights from the report is really commending the South African domestic markets to climate finance. Most of the funding that, as the report states, most of the funding has come from the domestic markets. And this also shows the enabling policy and regulatory environment that is spearheaded by our government to then do this. And I think, we really need to commend how the system is really coming together, where government, provides that enabling environment, the private sector participates, and of course, the development finance institutions continuing to play the catalytic, a role in mobilizing finance as well. So we really seeing how the deep capital markets in South Africa are coming to play. Where the opportunity lies is how we in future going to mobilize more institutional investors, because we see more months, more coming out of the commercial banks, and it's going to be critical for us to really start mobilizing, pension funds to really directly participate in these opportunities. As a development finance institution, we are, exploring the opportunity of water as an asset class, and we see this. The report has identified water as a key trend for climate finance, and we are currently, exploring water finance, water as an asset class, and having, developed a specific water reuse program within the DBSA that is, it's a partnership between the DBSA, the Department of Water and Sanitation, and National Treasury as well, have been mobilized funds for this through the Global Climate Facility. And this was all in the papers. But what I'd like to emphasize, Deepak, around this as well is, the project preparation funds, because when we mobilize, the water reuse facility, a portion, more than 10%, I think about 15% of that facility will be going to project preparation funds. And the report has really highlighted that need to mobilize project preparation funds. So we are really, really excited of this baseline that has been created in this report, and we will be taking the key recommendations seriously, in terms of the strategies and the solutions that we are going to be adopting in future, whether it be your blended finance models that we're going to be developing, the adjustments that we're going to be doing to our green bond frameworks, to support more adaptation in initiative, the capacity building we need to do for project developers, and in addition to that, the risk management mechanism and the green building frameworks as well that we are developing. And one last point is on how the report also recognizes the need for us to address the issue of cost of funds and the forex risks as well. We will not achieve net zero targets if we do not address the financial architecture. And that talks to, when you look at cost of funds on the continent, we need to address the issue of perception of risk on the continent. Yes, the risks are there, but we really need to address how these risks are taken into consideration when it comes to the much needed climate finance. The issue around cost of funds, I mean, it costs 4 times more in the developing world, to fund, climate projects as opposed to the developed world as well. And these are elements that are also coming through the report. So we really commend the PCC, Deepak, for this great work that has been done, the French Development Bank, CPI, these are really development partners for us in the country, and all the work that your team is doing. As DBSA, we are looking forward to working with you and also getting other development finance institutions to working with the PCC in coordinating financial flows going forward and coming up with innovative financing mechanisms as well. Thank you.
Thank you so much, Sis Boitumelo, for that. And you've really sketched out where the place of various types of funding should be located in this stack that needs to be created to ensure that we mobilize and scale up. Next respondent, without much ado, is Neil Cole, who is the financing manager, no small task, for the JET IP PMU. And it is his job to raise the gap of $90 billion that we have identified in the JET investment plan, understanding full well that the international pledges that came through accounted for something like 8.5, maybe close to 12 now with additional partners coming in. But I'd like to hear from Neil whether this report aids in any way the mammoth task that he and his team have to find a way of mobilizing and scaling up, creating the environment for the mobilization of those funds. Neil, the floor is yours. And thank you for joining us en route to COP28.
Thank you very much, Deepak. And let me also start by congratulating the PCC and also the team that put this report together. When I can answer your question right at the beginning and say that yes, the report provides us with valuable information that we are able to certainly use en route to and also at COP28. It helps us in framing the kind of approach that we would want to take in our engagements at COP28. The previous report, the one that covered the period 2017 to 2019, was valuable in framing the financing chapter in the JET IP and also contextualizing the approach that would be required to mobilize the financing that is needed as identified in the gap, an amount of close to 80 billion US dollars. Going forward in the way that we have approached the implementation plan and the way that we are thinking about the strategies that we'd need to embark on to close that financing gap. I mean, I can already see that this report is going to provide a valuable contribution to that. I mean, the one thing that is startling in the report, and certainly what I picked up when some of the findings were presented at the event at the JSE, was thinking about the JET implementation plan, which is really an implementation plan for the investment plan that was drafted and endorsed last year, is the number of shifts in the financing, and how the report, we hope, would be significantly different, or the next report would be significantly different. I think this is going to do with the IPG pledges that have come through in 2021 at COP26, and what we have in the implementation plan in terms of how that funding is going to be disbursed. On grants, I think the context there is that South Africa is not traditionally a high grant recipient country. I mean, Lungisa will bear me out here that, I mean, public expenditure or the grant contribution towards public expenditure has never been more than 2%, certainly during our time at the National Treasury. But grants are coming in as a very significant, or having to be a very significant contribution towards the financing for the Just Energy Transition Investment Plan, and it's certainly an important instrument in delivering on our just transition objectives. And also grants are going to be playing an important role in the kind of blending that would be required. So that, I think, is going to be a fairly significant shift in the next landscape that is undertaken, and the current findings in the report certainly helps us in thinking more strategically on how we want to strategize and take this forward. And this is certainly going to be a strong call that's going to be made by President Ramaphosa at COP28 in his engagements with other international leaders. On concessional and highly concessional loans, I think the challenge that we are facing, I think it's already come through in this report, and certainly going forward, is within the current climate of a tight fiscal position of the country, and how do we unlock these concession loans, and in particular those concession loans that are going to require sovereign guarantees, and in the case of Eskom, that will require the Treasury to provide an exemption for Eskom to borrow. But what this has done is that it has gotten us to think very carefully, and I think in creative ways, as to how concessional loans can be unlocked, because they would need to be an important instrument, and an important instrument that would certainly leverage private investment as well. But we do need to think about the high credit risk and what this means for public debt. But I certainly agree with, the point that Lungisa makes, and this is certainly part of our training at the Treasury, is that there is good debt and bad debt, and we certainly need to deploy our concessional loans that we've already identified towards investments that is going to contribute towards an uptake in economic activity. Going forward, I think it may be worth the authors of the report to think about separating the concessional loans and the highly concessional climate loans, because these terms and the terms and conditions of those two are quite different, and we certainly need to be identifying and calling for a lot more of the highly concessional climate finance, the kind of climate finance that is provided by climate investment funds and the subsidiaries of the SIF. And then just a final point on commercial debt and equity. I think we increasingly recognizing that. Well, let me make I think the first point, and the first point is that I think that it's certainly been impressive in terms of the contribution by the private investor community, and we already saw that in the 2017, 2019, and also in the current report. And I think it has a lot to do with the enabling environment. It has a lot to do with the renewable energy independent power producer program, and going forward, if we were to create the opportunities for private investment in transmission infrastructure, that's certainly a number that is going to tick up. And on transmission, I mean, the progress certainly needs to be made, because it is a hindrance at the moment to a further investment in renewable energy generation. And then just the final point, I think we in the JET project management unit, we increasingly recognizing that, you know, if we're going to be sticking to traditional instruments and think about it as, you know, sort of grants, concessional loans, and included in that would be the highly concessional climate finance, and then you know, commercial equity and debt from both private and from international and local. We're going to struggle to close the financing gap. I think we're going to have to be thinking very carefully, and certainly a message going into COP28 is that we're going to have to be innovative. I think there's going to have to be innovative ways in which we think about blending, innovative ways in which we reduce the risk to the sovereign, and how we, you know, start to introduce new ways in which DFIs, MDBs, private investors, and the public purse can participate in the way that we are going to be financing. And it's not just going to be about the quantum of the finance. So it's not just about, you know, we need more concessional loans. I think it's going to have to be about the quality as well. And to, I think, achieve that quality, we're going to have to come up with some innovative and possibly, you know, new types of instruments to finance our NDC targets and to reach our zero emissions objectives. Thank you very much, Deepak.
Thank you for that, Neil. We wish you well. Your work is really cut out for the next foreseeable future, but you provided a really good segue in fostering the notion of partnerships and blendedness in the solutions that are required for us to now have our next respondent, who is Leila Fourie, the Chief Executive of the JSE. Leila has had almost all her working life, actually, in the financial sector, seeing a number of different movies, and therefore from a number of different vantage points, an ability, hopefully, to let us know how the markets in South Africa, her institution, as well as the notion of creative instrumentation, can help us to mobilize and scale up for the climate finance needs for our just transition. Leila, the floor is yours, and thank you for joining us.
Thank you, Deepak, and thank you for inviting me to chat to you, and just to really reiterate the comments that have come before me, to say congratulations on a really excellent report, very insightful, and I think a very important report that comes at a very important time. I'm going to just sort of dive into a couple of elements, and Neil has already commented on some of those, relating to those areas that are related to us. We have had input into the report. We sit on the committee and we fully support the direction of travel. I think if we look at the finance landscape report component, you know, carbon financing is very much, as you say in your report, a resource efficient way to reduce emissions. And it has potential, as you say in your report, to channel new climate investment into South Africa and onto the continent. And the price that you report in your report of 134 Rand per metric ton of CO2 emissions places us on the sort of median of the global carbon price of about 192 per metric ton. And I think to a large extent, I fully agree with your report that you sort of make the comment that the carbon market is very much supply led, and that there are verification challenges. And some of the work that we've been doing is really to start to address that. So I think if we just step back and look at the continental perspective, we are seeing growing interest in carbon markets to reduce emissions and spur economic growth across the continent. And the African Carbon Markets Initiative is mentioning that carbon markets could unlock around $6 billion in revenue and support 30 million jobs on the continent by 2030. They also go on to say that over 120 billion Rand and 110 million jobs by 2050 could be created in Africa. And that's in addition to offsetting 2.4 billion tons of CO2. So this is a really important initiative, and I'm really pleased to see it in the report. I think, in terms of the future of carbon markets, we have seen historically low take-up. And if we look at the stats, only 23% of emissions are currently covered by carbon initiatives. Global carbon markets are expected to grow exponentially in the coming years, and there's an estimated value of about $50 billion by 2030. So this is a really important component for Africa and the global south to participate in. As we all know, the carbon tax was introduced in 2019 in our country, and this allows companies to offset 10% of their tax bill. This is going to increase to 15% in 2026. And that's really by buying taxable emissions or offsetting your taxable emissions through buying offsets. One of the criticisms that has been laid at or that's been raised in South Africa is that the structure of South African, our economy, isn't very favorable to carbon trading. Treasury has argued that trading is not suitable for the sort of oligopolistic type or nature of the economy, where you've got a few very large emitters, and those emitters could potentially, the argument goes, manipulate the carbon market to their benefit. And so the question, I suppose, to us is, how would we justify as the JSE our role in this? Our point, I suppose, is that we strongly support carbon markets, and we believe that carbon pricing is largely driven by the Carbon Tax Act in South Africa, and carbon emitters use carbon credits to offset their carbon tax liability. Carbon tax per ton is known. Treasury publishes this carbon tax indication up to 2030. So the maximum price for compliance is well known, and so it's not that easy to manipulate. Also, the benefits of the platform that we have launched is that it has global reach. So we have over 1,500 participants globally, and in a very transparent and a more liquid market. We've collaborated with Expansive, which is a pretty big provider globally in environmental market technology. And this is really to address the main challenges of carbon credits, such as setting up complex frameworks for implementation, getting policy support from government, etc. So we have ventured into the carbon markets, and it reflects an increasing importance of sustainability financing and environmentally responsible trading practices. So since we launched the VCM on the 9th of November, we have onboarded 5 potential clients. So that relates to the sort of concept of carbon markets. If I think more specifically, and Neil made mention of this section in the report, which is really the financial mechanisms and instruments for climate finance. In the report, it spoke quite extensively about debt as the predominant financial instrument. I think about 75% of financing came from debt, and equity was only about 18%. And the debt financing averaged was on average 98 billion rand per year. This is all, you would have read this in the report. So I think for us, a core strategic initiative is that we need to enable financing and partnering across the industry. And we believe that it's important to support the redirection of capital flows into sustainable development. And this could be done in debt or equity. So as at the end of October, we had 74 bond instruments in play, and that's across green, social, sustainability, etc. We had 9 ESG ETFs, and we have 2 indices that track responsible investment. So in 2014, the first green bond was actually listed by the City of Johannesburg. And in 2017, the City of Cape Town issued its bond for the green bond segment. And since then we've seen tremendous growth, whether it's we've got like 23 renewable energy bonds, we've got 15 green building or green residential bonds. I'm just sort of pulling out the big numbers. Affordable housing, we've got 17 bonds. And access to essential services, and this is really to improve access to public transport. We've got 10 of those. So we're starting to see quite a lot of growth and momentum, indicating that the market is starting to adapt to financing. We also have a private placement environment, which is JPP, and we've just recently seen a 2 billion, a 1 billion impact property financing company seeking finance. And we've got waste recycling, general recycling, solar power plants, etc. on that platform. So we are starting to see genuine growth. But even though there is growth, we have to understand how to accelerate the take-up of these instruments. And the insights in the report do provide us with a very useful context. We need to investigate the barriers to listing, and there are some that market participants have noted have crept in. And that includes those things that have been raised by engagement between our teams and the issuers. And I think that further work is also required to determine or to deal with the ease of access, the costs, and ensuring that real sustainable development is achieved. And then finally, I'll close on a couple of points around the blended finance section, which was in the finance landscape report. And there was a mention of this sort of section by Neil, but really just looking at the fact that the report raised that, there is a decrease in concessional debt and a reduction in the blending ratio for that debt in sort of 2019 to 2021. These figures are obviously, will be updated with, more recent data, but that trend is nonetheless something that we must think about. And the report made recommendations which I fully supported on the scale of the pipeline of investment-ready low-carbon projects, and also commenting on the lack, the bankable projects, which exacerbates the ability to support project readiness and early stage capital. And then project development is also, as the report has highlighted, and we fully agree, challenged by limited capacity and experience of developers. And so from our perspective, I'd like to say that blended finance generates very positive impacts. And there was an IFC independent evaluation group in 2020 that was arguing strongly that blended finance helped to set in motion high-risk projects that had the potential to generate positive, measurable, and social and environmental impacts in the areas of greatest needs. And the impacts also include the number of quality jobs, better and cheaper products, reductions in the GHG emissions, and also obviously finance return. And there is a strong focus on private financing. But the fact, and Neil made a point similar to this, is that private financing cannot be the only source, because the risks that are perceived by private financing are simply too high. And so we need to think about unlocking multilateral development funding. We need combined action. So blended financing can de-risk financial risks, but other partnerships like advisory services are also necessary to make sure that we are addressing this capacity issue. And then stronger market regulation and standards can also be reduced by assisting governments. So it shows that really blended finance can be more effective when it's done in combination with other actions. And so I think those were the key points that we wanted to make. And again, I'll come back to the point that we fully support the report. We think, Deepak, you and your team have done an excellent job, but we're really coming out of the starting blocks, and there's so much ahead of us, as the report highlights so with such clarity.
Thank you so much for that, Leila. And before I let you go, we have been, as a team, fielding all of the questions in the chat, but there is one that I thought I'd pose to you before we release you. And that comes from Kent Perils. And he says, can you please explain what methods and processes does the JSE voluntary carbon market exchange have in place to mitigate against the risk of high emitters buying carbon credits, but themselves do not deplete their own decarbonization efforts first before offsetting?
And I think this is an obvious consideration in carbon market trading. And we have to go back to what the objective or the benefit of carbon market trading is. And the benefit here is that the global south are often the recipients of very harsh climate change movements or legislation, but they haven't actually created the problem. And those large emitters are the ones that have created the problem. And I'm talking about the global north and the developed world. And so a carbon market gives the opportunity to ensure that emerging markets are in fact remunerated or paid for the carbon sinks and the greening that they have in the organization. Now, of course, some of these large emitters might simply opt to develop to use carbon credits. But the reality is right now, they can only offset 10%, and in a few years, they'll be able to offset 15%. And because this is a global market, to the extent that there is a demand by these high emitters and a lack of supply, the price will go up. And that pricing, that expensive, the cost related to buying a carbon credit has a natural encouraging effect to encourage institutions that with a high carbon footprint to step back and really think about what they're doing to reduce their carbon tax in the first instance. So, you know, a large part of that carbon tax can't be offset, and they still have to address that. And in addition to that, banks are starting to charge a lot more for lending in that space. And so there's another natural friction point, which says if you want to access cheaper financing, reduce your cost of capital, reduce your cost of funding, then you need to start reducing your carbon footprint and funding more green initiatives. I think in addition, there are other things like the carbon tax incentive that the government has introduced. And so it's not exclusively just about carbon taxes. I think there are a number of drivers that force these large organizations that are carbon emitters, not just simply to look the other way and buy a carbon tax to offset, but there are drivers to drive them to real transformation in that space. But it's a very interesting and quite complex question that I personally have spent quite a lot of time thinking about in our decision to enter that market.
Thank you very much for that, Leila. Nothing is simple these days, and I think the key message is that we have to start on this journey with all of the checks and balances in place so that high emitters can't carry on business as usual without their own transition plans being recognized and, in fact, with credibility endorsed by the markets from which they want to seek any kind of finance. Boitumelo, I'm going to put you on the spot. There is also a question in the chat, which I will field to you if you do not mind. What is DBSA doing to leverage financing from both domestic and international sources, for instance, with guarantees, first loss equity, interest subsidies, etc., for renewable energy projects and, in particular, smaller scale projects in South Africa? While we wait for Boitumelo, with just a few minutes left, what I'm going to do is depart from procedure a little bit. I know that there was, except for the Q&A in the chat, not really a chance given to participants to say much. But for the next 5 or so minutes, I want to check whether there are anyone amongst the attendees who would like to make very poignant and brief remarks. If you can put your hands up. Okay, with no hands up, let me try to reflect on the presentation of the report as well. I see Blessing has just indicated that if there are media and journalists online, if they would like to pose any questions, I'm not sure whether they utilized the Q&A function or whether by show of hands they want to pose a question either to the project team or to any of the respondents. Hendrik Lowe, if you could keep it brief, please, followed by Karen Ayton.
Good morning. Firstly, thank you very much for this report. I think this is an excellent report. I just think that one of the things that's perhaps worth adding to the report in future, it would be nice to see what the driving forces are behind the stats. Because it does differ quite a lot from the world, etc. Number one, and then number two, the so what question. We have this report now, so what? Something will have to happen with it. What's the management plans behind that? What is going to be the key learnings, and how is that going to be integrated into right from policy down to ground level going forward? I think that's some of the next steps that's critical, and it would be nice to present as well. So thank you very much.
Thank you for that, Hendrik. I'll try to cover some of that in my closing remarks. Karen, please go next.
Thanks, Deepak. A couple of points. I mean, the first loss issue and the de-risking of early stage projects has been coming up for 10 years. We need to find a solution for that. And I think the Treasury, working with DBSA and IDC, need to put their heads together to try and find a way of encouraging those projects into the system. And then the issue of defining what works and what is classified as climate finance. Outside of this fairly rarefied group of people, I find that a huge absence of understanding of what could be classified as climate adaptation projects or water projects. And I think that there is more needed to socialize the thinking around it and to encourage greater investment in things that have a climate benefit, but are not necessarily labeled in the first instance climate.
Thank you for that, Karen. I will also try and cover very briefly, watch the space for a forthcoming report that we're going to open up for public comment. Tunisia, I saw your hand up and then down. Do you want to come in?
Hi, everyone. Thanks for taking my question. I want to pose a question that, I'm not sure who would be able to answer it, but it is on COP28 and our negotiating mandate. Will this report sort of inform how we approach the COP28 negotiations? We are seeing that grant and concessional finance is critically low at this point, and 2030 is around the corner. We have these higher, ambitions that we put forward when we submitted our last NDC. So, is there any anticipation that this report could, inform and impact how we approach this year's negotiations at COP28?
Thank you very much for that, Tunisia. I'll also try and speak to that briefly, even though the PCC does not have a mandate to talk about South Africa's negotiating position at COP28. Colleagues, thank you very much. We started with a very high number and we've lost some people, I suppose, because 2 hours is a lot to ask for people to commit. But I just want to use this opportunity to thank the project team firstly. Secondly, the respondents who each one of you have added tremendous insight and value. And to come back to the question that was raised about, we have this information, so what? As the climate finance team in the PCC, we have been very much seized with understanding what the landscape looks like. And we have also been very much seized with looking at ways in which we can make a contribution to deal with issues raised, in particular by Lungisa, as well as the other respondents, related to risk measurement, risk pricing, and of course, the issues that Karen has talked about with respect to de-risking. These are all ongoing project streams within the PCC. We wanted to, for want of a better word, sterilize this project from policy issues, from trying to make qualitative assessments of what might be the drivers, except for, of course, the projects themselves and what flows actually take place. And we, by doing that, do not fail as the PCC to understand that on the back of this very scientific, empirical, and methodologically sound project, we need to develop a work plan. And part of that work plan is, in fact, and I'll ask the banner to be put up that we had prepared. You don't always all have to look at my face while I do the closing. We have, as it relates to definitional issues, have seen that that is not necessarily a weakness, but it's a space in which we need to get consensus about definitions. And therefore, in the pause year of this project, which is next year, we will be refining the methodology. We will be closing the data gaps that we know do exist. However, we've done the best we can in this project to measure on an actual as well as primary basis what the flows have looked like. With respect to questions related to public and private, it gives us lots of food for thought as we deal with the issue in a limited or constrained fiscal environment, how to ensure that the fiscus, but also government through policy and regulation, eases the barriers through which we can mobilize and scale up. Leila has talked about the need for instrumentation and more novel, innovative ways to allow investors and funds to find their locational purpose within the just transition framework, and that will also be explored going forward. With respect to COP28, we will be showcasing the findings at COP28. And from a policy point of view, the minister has also made it clear that at the COP, there will be a call for greater levels of participation by the developed world, greater levels of grant. In fact, the president himself has called for that. But what the study also shows us is that the bulk of the flows have been from domestic sources. And therefore, while we await our rightful share of global climate finance, I think we have a burning platform from which to begin to own our own transition and find the innovative and capacity, innovative means and the capacity that is required to get on with the job of funding our just transition. Finally, the banner that you see on your screen is work that we're doing to ensure that the justice components of the transition do not get left behind, are not then the Cinderella child of the financing that is required to enable our full just transition. We will be publishing by the 4th of December, which is Monday, a just transition financing mechanism proposal for public comment through the holiday period. So please take it as holiday reading, and we will want comments in by the 25th of January. And we will also socialize what we believe to be the imperatives to ensure that the justice components get their fair share in the sun and hopefully their fair share of the financial flows. With that, let me once again thank you all for joining this event. It is the last PCC public event before we go off to COP28, and it has been a great pleasure to showcase the findings of the climate finance landscape in South Africa 2023 in a domestic dialogue before we showcase it on international platforms. With that, thank you very much once again for attending, and I wish you all a very pleasant day going forward. Thank you. And
thanks very much. Thank you.